Thanks everyone for joining us this afternoon. Today's webinar, we're going to be talking about trading earnings using options. And this is especially relevant given that we're about to go into earnings season. So we want to give you guys some ideas as to how you can take advantage of bullish or bearish bets on earnings announcements with limited risk using options. Now, before I get into this, I do want to say trading earnings is a risky proposition. The examples that today we're going to go over are not recommendations to trade specific securities or necessarily to trade earnings, but we want to illustrate to you guys how option pricing changes around earnings so that you at least have the tools to understand how you can use options to be able to take bearish or bullish bets on individual stocks going into earnings season. So with that said, we're going to go right ahead and talk a little bit about the earnings season as a whole. We're going to talk about what happened last season, what our expectations for this season is going to look like. We're going to talk about the different sectors that are looking attractive or not attractive for Q2. And then what we're really going to do is we're going to get a little bit into option Greeks or the pricing of options because we need to understand three Greeks that affect options around earnings in order to understand how to trade them. And then what we'll do is we'll wrap it up by going over what are the actual changes of option pricing around earnings, because once you understand that, you'll be able to understand how you can make effective bets on earnings announcements using options. And for those of you that are new to OptionsPlay, welcome. Today, what we're going to do is we're going to go over some live examples of how to use our P&L simulator so that you can see very clearly different scenarios and how earnings announcements will impact your option pricing and see how your expected P&L for each strategy will look like. For those of you that have used OptionsPlay, welcome back. Once we're done with this webinar, I encourage for those of you who have not seen OptionsPlay to go on the TMX website and sign up for it. It's free of charge. It's a great tool that's available to you guys, not just for earnings plays, for all different types of option strategies. So if you're just looking to make some directional plays, you're looking for some income strategies for stock that you own, OptionsPlay is designed to help you with that. But today we're just going to look at how to use the P&L simulator so that you can test out different what-if scenarios and see how option prices change around earnings season. So with that, let's just go ahead and get started. We're going to talk a little bit about what the season brings, what we're looking at. So what we're going to do first, we're going to look a little bit at what happened the previous quarter. So in Q1, we had pretty strong top and bottom line growth. So both sales and earnings saw pretty strong growth in the first quarter, which is certainly bullish on the overall picture. And the one highlight I will say about Q1 was that earnings beats were above average in Q1. And a lot of that comes down to corporations shaving expenses, shaving costs. That really caused a pretty big beat on the earnings side. On the sales side, it was pretty much in line with historical averages. So Q1, we saw a lot of cost cutting, which ended up giving us some higher earnings per share beats than normal. So going into Q2, forecasts currently show relatively strong guidance going into Q2. We haven't had a lot of negative revisions going into the earnings season. Most of the revisions were either neutral or positive, which certainly bodes well for this specific earnings season. And one thing to consider is that despite the fact that we've had strong guidance, we've had also an extremely strong start to Q2. It's very early days, but the few companies that have reported have been very strong, even though we have higher expectations. So those two things are certainly very encouraging for this earnings season coming up. And the one big thing that we need to be aware of is the strength of the Canadian dollar is causing a bit of a drag on some of these Canadian stocks. The unexpected rate hike back in May has caused the Canadian dollar to rally significantly up to that 80-cent level, which has made investments in other countries a bit more attractive than in Canada. So that's going to create a bit of a drag on corporate earnings this season. So those are the few things to kind of look out for in terms of what we're expecting for Q2. So looking at the different sectors, we want to look at which sectors are screening relatively strong, meaning these sectors have seen upward revisions for both sales and earnings per share. These are sectors that, number one, consumer goods. This is specifically the net importers. These are Canadian companies that buy their goods in the U.S. and sell them in Canada because of the strong Canadian dollar that has benefited companies that do that. Financials also, in a higher interest rate environment, are looking a little bit more attractive with higher margins as interest rates continue going higher. And lastly, energy. Energy has really lagged behind the markets over the last year. However, we're hopefully seeing oil prices starting to stabilize. We see a lot of these firms have shed assets, cut dividends, and are in a better place financially than they were a few quarters ago. So we might start seeing some surprises from the energy sector. And on the downside, for downward revisions, utilities certainly is a sector that's not as attractive as interest rates go higher, and utilities many times trade closer to fixed income than they are as equity. They become less and less attractive as interest rates go higher. And also railways that has suffered a bit from the strong Canadian dollar is screening on a bit more negatively going into Q2. So with that gives us a picture of what our expectations are for this earnings season. Those will change as we get into the earnings season and see what the reports look like. But so far we've had a pretty strong start to the season, so we're expecting some nice sized moves, perhaps to the upside for this quarter. So now that we've gone over an overview of what our expectations are, now I want to talk a little bit about the option Greeks. The Greeks are very important because it helps you understand how an option price is impacted based on other things that are going on. So 3 Greeks that we are most interested in understanding is delta, vega, and theta. You don't have to memorize this, because what we're going to do is we're going to show you how you can use our platform to help you calculate these things. You don't have to know how to calculate any of these things. I just want to give you guys an understanding as to what these 3 Greeks mean, so that you have an idea conceptually. These are the 3 things that affect option pricing around earnings the most. So these are the 3 things that we think you should be aware of. So number 1, delta. It's the change of the price of the option in respect to the change of the underlying stock. What does that mean? So if you see an option has a delta of 0.5, that just means for every dollar the stock moves higher, the option price will move up by 50 cents. If the stock goes down by $1, you'll lose 50 cents on the option. So when you're trading earnings, you're expecting the stock to move up or down based on whether it beats or misses earnings. So the delta tells you how much your option will increase in value or decrease in value depending on how much you expect the underlying stock to move. So very important, because you do expect a move in the underlying stock. Vega is the change in price of the option in comparison to volatility. So when you're looking at Vega, if you see an option with the Vega of 0.25, that means for every 1% change in volatility, implied volatility that is, you'll expect either a 25-cent gain for every 1% higher in volatility, or a 25% loss in the option price for a 1% downward change in volatility. So volatility is an important one to understand, and it's something that I think most of us conceptually have a tough time understanding. But volatility does change around earnings, and we'll talk a little bit about that in the next slide. And lastly, theta is the change of the price of the option in respect to time. Time is the one thing that's constant that we don't have any control over. So basically, as time goes on, the option will lose some value every single day. We call it time decay. Theta measures that time decay and tells us exactly how much we're losing. So if you see an option with a theta of 0.10, that means this option is losing 10 cents a day every day that goes on. So those are the 3 factors that are most important, understanding how option prices are affected during earnings, because change in the price of the stock, change in volatility, and change in time are the three things that will happen around earnings. So these three Greeks tell you how it affects the option pricing once earnings comes about. So in the beginning of the webinar, I talked about options or trading earnings announcements with options as a relatively risky and somewhat difficult task to do. So in order to do it correctly, you must fully understand how these three factors affect your option pricing. There's two things that are always constant when you're trading earnings. Well, number one is that there's a volatility crush right after the announcement. What that means is right before earnings announcements, volatility tends to pick up because there's a lot of uncertainty as to where the earnings is going to come out. So the option will usually trade at a higher implied volatility right before earnings, and the second earnings comes out, it comes back down because that uncertainty is gone. We know exactly what earnings were, and that change in volatility downward is what we call the volatility crush. And basically what that means is that your option price will decrease in value the second the earnings announcement comes out because of volatility. The other thing you always have volatility working against you when you're trading options going into earnings. The second one is time decay. Like I said, time is something that you and I cannot stop. It will continue marching forward, so that option value will continue to decay as time goes by. So when you're trading options, I call it one step forward, two steps back, because no matter what, you always have volatility and time working against you. So in order to make any money, you must have a large move in the underlying stock on either a beat or a miss, and it has to be a large enough magnitude to overcome the losses that you've experienced from volatility and time decay. So you have two factors working against you and one factor working in your favor. And even that one factor working in your favor only works in a very few scenarios. What do I mean by that? So you can choose the right direction, but it also not only has to be the right direction, it has to be a large enough move for your strategy to overcome the losses that you have in volatility and time decay. I'll show you that, guys, with a real life example on our platform in just 2 minutes. So bear with me with 1 second. So not only do you have to pick the right direction, it also has to be a large enough movement on the underlying stock to overcome the losses that you have in volatility and time. So that means that you could pick the right direction, but maybe the move's just not large enough. And sometimes if that move isn't large enough, you still can't overcome the losses that you have in volatility and time. So you might be able to pick the wrong direction, but if it's not large enough of a move, you're still going to likely lose money on that trade. Additionally, if you're completely wrong on the direction, whether it's a large or a small move, you will likely lose a very large portion of your investment on the trade. So that's why, generally speaking, this is a tough way to trade. However, the potential to make a high amount of return in a short amount of time is usually what attracts people to trading earnings. But as long as you understand that these are the factors that are working against you, then you can proceed to start looking at different strategies and seeing, is there an earnings opportunity that suits you or not? And we'll go through some real life examples for you. So talking about trading strategies, what can you trade if you expect a beat or a miss on the underlying stock? So the first strategy, or the simplest strategy, is to simply buy a call or a put. Buy a call if you're bullish, buy a put if you're bearish. This gives you unlimited profit potential. So this is really when you're expecting large moves in the underlying stock due to earnings. You're expecting a large, quick move. You want to buy a call or a put, which gives you that unlimited profit potential. It does require a larger amount at risk. So this is, even though it's one of the simpler strategies, you're putting a little bit more capital at risk by trading a long call or a put. For those of you that are a bit more sophisticated, I'd recommend taking a look at potentially a call or a put vertical. Long call vertical if you're bullish, long put vertical if you're bearish. Now, this strategy gives you limited profit potential. So this is usually expected if you are expecting more of a modest move or a slower move. So a lot of times the moves on earnings doesn't necessarily happen on the first day. there might be quite a bit of follow through over the next few days, next week or so. So if you're expecting more of a modest or slower move, you might want to take a look at a long call or a long put vertical. It does put smaller amount of capital at risk, so if you're wrong, you're losing less money. And the other thing is time decay is a little less sensitive on the long call vertical or the long put vertical compared to just buying a long call or a put. So those are the two strategies that I recommend to start with if this is your first time trading earnings. And when it comes to picking expirations, you usually want to pick expirations that are at least 1 to 2 weeks after the earnings date, because you want to give it a little bit of time, because many times after an earnings announcement, there's quite a bit of follow through over the next few days. So you want to give yourself some room so that if the stock misses and continues going lower, you want to make sure that you might be able to capture that continuous move lower. So you want to give yourself at least 1 to 2 weeks after the earnings expiration or the earnings date before you go ahead or pick an expiration that's at least 1 to 2 weeks past the earnings date to give yourself some time. So with that, let's just go ahead and start looking at some real examples so that I can show you these concepts that we just talked about. So we're going to bring up the OptionsPlay platform. For those of you that are new to OptionsPlay, this is the platform that's available to you free of charge through the TMX website. So for those of you that are new, I highly recommend you to go and sign up, because this will be able to provide you with a lot of educational and analytics for getting started with trading options. And we have trade ideas and watch lists here on the left. We have our equity analytics panel here in the middle, and we have trading and income here on the right. These three panels are designed to give you everything you need to start looking at different symbols, understand why you need to look at those symbols, and lastly, how can you leverage them into a trading or income strategy. So today we're going to be talking about trading strategies for earnings. And for those of you that have watched our previous webinars, if you are interested in any of the other topics, just go to our YouTube channel and you can see some of those. So today we're going to go through a few life examples, and I have brought up 4 or 5 different stocks that we're going to take a look at for bullish and bearish opportunities. But I do want to point out again that these are not recommendations to trade these specific securities. These are just stocks that I picked because they have earnings coming up. So keep that in mind. This is done for educational and illustrative purposes. Please do your own research before you go ahead and place any trades for earnings. So we're going to start off with TransCanada Corporation, an energy stock. We talked about energy being a possible sector that might surprise us to the upside. So let's take a look at how can we trade TRP on earnings. This stock reports earnings tomorrow on July 28th. So let's take a look. So by default, what I can do is I can click on I'm bullish and be presented with 3 bullish strategies. You can see here it's telling me I can buy 100 shares. I can buy September 15th 62 call, which is basically the at-the-money call. And I can buy the September 15th 62 by 66 call vertical. So these are the 3 strategies that are presented to me by default. Like I said, when it comes to trading earnings, you want to pick an expiration that's usually about 1 to 2 weeks after earnings. So let me change this from the September expiration to the August, let's say the August 11th or the 18th, either one. Let's choose the August 18th to give us a little bit of room. So again, I'm trading the August 18th 62 call or the 62.66 call vertical. And what you can do is you can use our P&L Simulator. So we talked about 3 things: delta, theta, and vega, or delta, vega, and theta. So what those represent is the underlying price, what happens if the stock goes to a certain price by a certain date, and volatility is a certain amount. So what we know is that right after earnings, so let's pick a day right after earnings. So this reports earnings on July 28th. So let's take a look at a few days after on August 1st. What happens if on August 1st, we know that volatility usually comes down after earnings. So let's say what happens if volatility comes down to around 11% and the stock stays exactly where it is. So as you can see, if on a few days after earnings, volatility comes down and the stock doesn't really go anywhere, I'm losing about a 16 or 17% loss on buying this call. I'm losing about 14% of my investment if I had bought this call vertical. So we talked about the two things that are working against us, volatility and time. Those are the two things that we can't do anything about. However, we can have a view on the underlying stock and where we think it's going to go. So one of the things we can do is we can start saying what happens if the stock does go a little higher after earnings. So as you can see, as I move my mouse up to about $64, that's when this call vertical starts getting a profit, right around $64. And same thing with the call, right? So both of these strategies become profitable right around the 64 area. So that means basically that stock needs to move about 50 cents higher before these strategies become profitable on earnings or a few days after earnings. So the question you have to ask yourself is, do you think the stock can go above 64 after earnings? If you do, then you certainly might want to consider taking a look at these strategies. So if you think the stock's going to go up to 65, as you can see, this makes a 44% return versus a 40% return. If you think it's going to go even higher to 66, you'll get a much even higher return. So this starts to allow you to play around with the different scenarios to say what happens after earnings. I know that volatility and time is working against me. How far does the stock need to move in order for me to be profitable? And that's what the P&L simulator is designed to do, is allow you to understand what scenarios or how each one of these strategies perform under different scenarios so that you can make that direct comparison and say, if I think this thing's going to go to $66 a few days after earnings, I should probably take a look at buying this call because it gives me a 92% return versus a 73% return. Conversely, if let's say you're completely wrong and the stock plummets on earnings and goes down to $62, as you can see, you're losing about 70% of your investment right here. So that's only about $1.50 move lower. So if that was to happen on a miss, you know, this might be a realistic scenario for you to look at, is expecting about 2/3 or 3/4 of your investment to be lost if you're wrong on the specific trade. So this allows you not only to look at what happens if the trade goes in your favor, but also what happens if the stock goes against you. So you know, this is again just for illustrative purposes. I'm going to go through a few more examples to hopefully give you guys more of an idea as far as how this works. So we just looked at TransCanada. Let's take a look at Manulife. This is a financial. We talked about financials being a possible strong sector for this quarter, given that we're looking at higher interest rate environments. So let's look at Manulife. This reports earnings on August 9th. So again, what we're doing is we're showing 3 bullish strategies: buying the stock, buying a call spread or a call vertical. Let's just modify the expiration dates a little because we're going to look at the August 18th since this reports earnings on August 9th. So let's pull up the August 18th call and call vertical, and let's go back to the P&L simulator. So again, let's look at what happens a few days after earnings. This reports earnings on the 9th, so let's look at, let's say, a few days after on August 12th. We know volatility comes down after earnings, so let's say it goes down to about 14%. And what happens if the stock stays exactly where it is? So volatility working against us, time working against us. If the stock stays exactly where it is, you're going to lose about 21% on buying this call, about 1/5 of its value. Same thing here in the call spread. You're losing 18%, approximately 1/5. So let's take a look at how much does the stock need to move in your favor before these strategies become profitable. So here it's telling you it'll have to move to about 25.72, which for a stock trading at 25.56 is really not that far off. That's only about 20 cents higher, if even that. So here, the stock only has to make a very modest move higher in order for this strategy to be profitable. So this looks like a fairly attractive trade if you do expect this stock to beat earnings. So if let's say the stock goes up to 26, you make about a 34% versus 39% return here on this. If you expect this to go any higher, 26.50, 100% return, 104% return. So here, even if the stock moves approximately $1 higher, you're looking at a pretty nice sized return on both the call and the call spread. Again, this is given that time goes by and volatility comes down, you're still expected to see pretty high returns on this specific trade. Vice versa, if let's say the stock plummets and goes down to 25 bucks, which is fairly possible. As you can see, the downside to this is that even a small move higher, a small move lower, you're going to lose majority of your investment, about 3/4 of it on the call and the call spread if this trade doesn't work out or goes against you. So this just gives you a very clear indication as to what happens if the stock goes in your favor, what happens if it doesn't, so you can easily determine whether this is a trade or a risk that you want to take in your own account. And this tool allows you to calculate what the expected impact of the underlying stock volatility and time has on your option trade, but you don't have to do any of the calculations yourself. It already does all the calculations for you, tells you exactly what the expected return is, and even highlights for you which strategy gives you the highest return, so that there's no doubt in your mind as to, with your given scenario, which strategy you might want to use. So let's just go through a few more examples, because I think that's the best way to understand and teach these concepts, is to just practice. Let's take a look at Fortis. This is a utility company. We talked about utilities being a sector that may be less attractive in a higher interest rate environment. So let's take a look at some bearish possibilities. And again, this is not an indication to tell you we think this is bearish. This is just for illustrative examples to give you an idea as far as if you expect a stock like this to miss on earnings, how you can take advantage of that. So again, for this particular case, I'm going to click on I'm bearish, and now I'm presented with 3 bearish strategies. I can either short sell the stock, I can buy a put, or I can buy a put vertical. This stock has earnings coming up on July 28th, so in 1 day. So let's change that expiration date to maybe in August 18th, or maybe even the 11th. And then let's take a look at the same thing here for the put vertical here. So I'm going to change this to a different put vertical. So let's see, we could buy the 44.5s or 45s. And then let's go back to the P&L Simulator. So I've changed the expiration dates to August. I've changed the strike prices a bit to fit my expected range. Now let's say what happens in the few days after earnings. So earnings is on July 28th. So let's walk that forward a couple of days. Let's say to August 1st. We know volatility is going to come down a little. Let's say it goes down to about 9% after earnings. And what happens if the stock stays exactly where it is? So as you can see, you have a fairly low loss here on both of these strategies, because it's only a few days from expiration. Volatility is going down only by a couple of percentage points, so you're not losing a ton of value to volatility or time. So let's see what happens if the stock moves even just modestly lower. So as you can see, even if the stock moves down to about 44.40, which is only 10 cents lower, you're going to expect a positive return on both of these strategies. So the stock does not need to move very much on earnings for you to be profitable. So if you think the stock might miss on earnings and go down to, let's say, $43, as you can see, you'll make a nice 92% versus 107% return on this call vertical by if the stock was to miss earnings and go down by, let's say, $1.50 or even $1. You'll still see some nice size return, 61 versus 91% return, and vice versa. If you think the stock's going to go higher, as you can see, you can calculate your expected losses if you are wrong on this specific trade. This is really designed to help you guys play around with different scenarios, use these sliders so that you can really test out all the different scenarios with not only respect to time, but also what happens if you think this thing's going to go down to 43 bucks, but it might take all the way till expiration to do that. So as you can see, if you expect the stock to move lower and you want to hold it all the way to expiration, this vertical here gives you much higher return than just buying this put, and that's really due to time decay. The time decay on a put spread, when you're this far, when the stock moves in your favor, is that time value starts to work in your favor, and that's why you start to see a much higher return here on the put vertical as you approach expiration, versus this strategy is actually losing money as you approach expiration. So these are all the things that you can play around with. Time, you can even change volatility if you want. However, like I said, volatility always comes down after earnings, so any adjustments you make to volatility going after earnings should be to the downside, not to the upside. And then you can see exactly which strategy gives you the highest return and highlights for you, so that you can make easily a decision as to whether or not this is a trade that you want to make. So let's just do one more example. Looking at Thomson Reuters, this is a technology company that primarily services financial services. I don't particularly have a view on this specific trade, so we can look at both bullish or bearish examples here. We can take a look at bearish strategies or bullish strategies. So let's take a look at bearish, simply just because the 1 month and 6 month trends are bearish right now. So let's say you think that this stock might miss on earnings. Again, when you click on I'm bearish, you're presented with 3 bearish strategies: shorting the stock, buying a put vertical. This stock has earnings on August 1st, so about 5 days from now. So I'm going to adjust my expirations to maybe the August 18th, which gives me 2 weeks or almost 3 weeks after earnings. And let's see what happens on expiration. So if the stock is on August 1st, let's walk it a few days after. So let's say on August 4th, everything stays constant and volatility comes down a little to, let's say, 14–15%, and the stock stays exactly where it is. As you can see in this particular case, if just due to volatility and time, if the stock stays exactly where it is, I'm losing a very large portion of my trade to time decay and volatility. Here, I'm losing 38%, so almost 4/10 of the value just on volatility and time, or 32% here on the put vertical. So quite a bit. 4/10 to a third. So that means the stock really needs to move quite a bit in my favor before this strategy can be profitable. So let's take a look. The stock really needs to move down to about 56.85, so almost 80 cents in order for this strategy to be profitable. So quite a bit, a little over 1%, almost 1.5% move to the downside in order for these strategies to be profitable. So the stock really needs to move considerably lower to, let's say, 55.5, so about $2 in the money, $2 lower than where it is today. In order to see some nice size returns in the 60 to 70%. So this might be a little less attractive from a trading perspective, because you're losing so much money to that volatility and time that you have to make all that up with a large move in the underlying stock. So this is really designed to help you understand how much value are you going to lose to volatility and time, so that you have a gauge for how much does the stock need to move in order for this strategy to be profitable. So as you can see, on the higher end of the spectrum, you'll probably lose about a third to maybe even 4/10 of the value of the option just to volatility and time decay. On the shorter end of the spectrum, sometimes you might only lose 10 to 15% of its value. That would be considered relatively low. So think about that. That's really the spectrum of the option premiums that you're expecting to lose just to volatility and time value. So make sure that you understand that the stock really needs to make not only a move in the right direction, but it has to be large enough for you to overcome that volatility and time decay. So that wraps up the webinar that we're talking about today, in terms of how you can use the OptionsPlay platform to better understand how you can trade options around earnings. So just to sum up a little, like I said, earnings is not an easy thing to trade. It's extremely important that you understand these 3 factors: how price action, how time decay and volatility affects your option pricing around earnings. So as long as you understand that volatility and time is constantly working against you and you need to make up for it in the underlying stock move, you can use the P&L simulator to create those scenarios, see what your expected returns, if the stock goes in your favor, if it goes against you, weigh the 2 by each other and decide, is this the risk reward that you want to take? So I hope you guys enjoyed this webinar. I hope you guys have found this educational. Like I said, for those of you that do not have access to OptionsPlay, I highly recommend you to go to the TMX website and sign up for a free version of this. This is absolutely available to you free of charge for Canadian derivatives. So I highly encourage you to do that. And we'll be back in the next few weeks, and we'll be talking about a new topic to teach you guys a little bit more about how to use this platform for options trading. Thank you very much, and I hope everyone has a good afternoon.